All right, everybody, we're just about at the top of the hour, so let's go ahead and get started here. I see some people are still trickling in, so let's go ahead and take care of some minor housekeeping stuff before we get started. If you don't have a pen and paper to write down notes, I suggest you do that now. There's going to be probably some things you'll want to jot down and reference later after the webinar is over. Throughout the webinar, we're going to do some questions and some polls. I like to keep things interactive, so if you could participate, that would be great. And then also, if you have questions throughout the webinar, I'm not going to be looking at the questions on the sidebar. There's just not enough time for me to do that. But if you do have questions at the end, which you probably will, towards the end, there will be an opportunity to get all those questions answered, and I'll show you how to do that. Let me really quickly introduce myself. My name's David Emery. I'm the owner of Emery Advisory Group. We are a small business development firm. We work with medium to small size businesses. We especially work with startup companies to help them get going. We are cash flow experts here. We also do full service accounting and bookkeeping. And we specialize, of course, in corporate taxes. We also do some branding and things of that nature, but we really focus on the financial side of the business. And I spent about 2 years really delving into the topic of business credit and how it works. And I'll kind of cover that story with you guys a little bit later on. But I discovered some really interesting things, and I'm going to share that with you here today. We are not going to be discussing the process of how to build business credit. We're just going to be discussing basically what is business credit, how it works, why you should care about it. If you are interested in how to get your business credit established really quickly, I actually teach another course called Business Credit 101. There's about 6 hours of lectures in that course, as well as interactive material. There's a workbook. We can talk about that later, but that's beyond the scope of this webinar. We've only got about 25 minutes or so here. I'm going to try and keep it close to 25 minutes if I can. And so this is really a crash course. So again, if you have questions, save those for the end, and we can try and cover those for you. Let's go ahead and get started. So today's agenda, we're going to be discussing, like I said, why you should care about business credit. How does this powerful yet misunderstood tool help entrepreneurs grow sustainably? And sustainability is the key. Why do we do it? So why does Emery Advisory Group exist? Why do we focus on business credit? Why did we completely jettisoned our personal credit repair that we were doing? We don't even care about it anymore. Business credit is really a much more powerful tool. And we'll talk about why I spent 2 years of my life mastering that and figuring that out. We'll talk about the nuts and bolts of what is business credit, how is it different from consumer credit, and what can it be used for, and why you can't afford to ignore business credit. We'll kind of go over some common misconceptions about it and why it really is the best secret weapon in your business arsenal. So let's dive right in, guys. What is the big deal? Why should you care about your business credit? Well, like I said, business credit is such a much more powerful tool. It really causes us to reconsider how we use our personal credit. And I hope by the end of this webinar, you will realize that you should never, ever give out your social security number for any type of business lending or credit or trade line or vendor account ever again. So it's really the cash flow secret weapon. Business credit is used to grow your business. Now, I want to get real with you for a second here, guys. I know many business owners consider credit a 4-letter word, right? They consider credit to be basically debt. They associate the word credit with debt. And what's so important for you to understand is that business credit is used to improve cash flow for your business. It's not necessarily about going into debt. In fact, I have clients who we have coached to leverage their good business credit to double their revenue. And it doesn't take long, by the way, guys. Like, I've got a client who was a roofer who went from making $120,000 a year to $250,000 a year in 12 months by using his business credit. And again, business credit can be established and built in a fraction of the time of consumer credit, making it perfect for startups. It also provides peace of mind because you don't need to provide a personal guarantee or any personal credit checks to obtain financing. But 95% of small business owners will never take advantage of their business credit. So guys, there's this article I want to share with you from Forbes, and it was not that long ago. Let me see if I can highlight this. It was, we're looking at right here, February. It's hard to see. It's February 19th, 2018. So really not that long ago, guys. And basically, this article makes a really, really strong point. In fact, it really vindicates us and confirms everything that we have been saying to our clients over the past, number of years about this topic. Before I go and dive into the article, let me just give you a quick rundown of the background of what's going on in the article. Basically, there was a study done of 5,000 business startups, and they examined over that's like a 15-year period that they looked at these, and they really focused on the first 3 years that they were in business, and they break them down into 3 categories. And that would be businesses that started using business credit to fund the business. They looked at businesses that used personal credit to fund the startup of the business. And then they looked at another group of businesses that did not go into any debt and did not borrow or use personal or business credit at all to operate in the first 3 years. Here's what the study found. The researchers have concluded that a company using a business loan to finance its start period reported nearly twice as much revenue after 3 years as a startup of similar size that took on no debt. By contrast, that same company financed by personal debt, say a home equity loan or personal credit card, had on average 57% less revenues than one that hadn't borrowed. Okay, so they actually cover all 3 of those categories here. We first talk about the companies that used business credit to get started, and then they talk about those that used personal credit and those that didn't borrow. A company with business debt then generated on average more than 4 times as much revenue as one with personal debt. So, stick with me here, guys. I want to cover all 3 of these. And what I did was I actually took the data from the study and I plotted it on this chart. And what we find is in the beginning phases of the company over the first 3 years, here's what happens. So this chart actually represents a percentage difference in the reported revenue for 5,000 business startups over their first 3-year period. So the black line, which is on the bottom, are those companies that received a personal loan, whether that was a home equity line of credit, just a traditional unsecured personal loan, credit cards, personal cash advance, things like that. The red line would be those businesses that got unsecured business loans. So that could be SBA, a bank loan, in the name of the business, factoring advance, or something like that, where it's unsecured, where the business owner never actually gave out his social security number. Everything was in the name of the business. They didn't leverage their personal credit at all. And then the gray line, which actually falls right in the center, would be those businesses that didn't utilize any financing or credit in their first 3 years. And that, by the way, guys, was actually the fewest number of businesses did that. The vast majority of businesses had to use some sort of credit to get started, whether personal or business. And what you see is that the businesses that used true business credit ended up generating over 4 times as much revenue, or I should say almost 4 times as much revenue than those businesses that used personal credit, and more than double the revenue of the businesses that took on no debt. So if we keep reading down in the article, there's something else really important that the researchers mention. So it says, but why does personal borrowing predict such poor performance? Worse than taking on no debt at all. An owner who immediately borrows from a personal line has less room to grow. And this is a quote from the researcher. If a firm is borrowing in the name of the owner at startup, then it has used up at least some of that debt capacity. We're going to talk about debt capacity. What they're referring to here is essentially what they call utilization, and you guys have probably heard that term. Whereas a firm that does not borrow in the name of the owner retains that debt capacity to use in subsequent years if needed. So guys, I mentioned that there's going to be some questions throughout the webinar. This is the first one, really simple yes or no question. Have you ever been approved for an SBA loan? I know that just about everybody who's watching the webinar today is a business owner, or else you want to be, or maybe you were one in the past. So my question is, have you ever been approved for an SBA loan? And we're going to close the question here in just a moment. I probably should ask, do you even know anybody who's been approved for an SBA loan? Because it's really hard to be approved. But people talk about SBA loans like they're this big deal that you need to get when you start a business. Anyway, I'm going to close it. So if you haven't answered the question, it should be right there on the screen in front of you. Yes or no. We'll close it here in 5, 4, 3, 2, 1. Okay. Okay, so it looks like 4% of today's attendees have been approved for an SBA loan. So just based on the number of the people who are watching here today, that's probably just one, right? One person. So yeah, SBA loans, they're not easy to get. So if we refer back to the SBA, we learn what I like to call the cash flow problem. See, the SBA reports that the number one reason why a new business fails is due to mismanagement, and that makes sense. People don't know what they're doing when they start a business. They got big dreams and high hopes, but they've never run a business before, and the business doesn't make it. But the second most common reason, it's a close second for a business to fail, is lack of funds or poor cash flow. And in fact, the SBA also reports that most entrepreneurs will approach friends or family to borrow money at least once in the first 3 years. And most business owners say that they never calculated the cost of borrowing money into their budget when they started their business. And that shouldn't be surprising. I'm sure most of you, if you started your business, you remember laying out your business plan, right? And there probably was not a line item on your business plan for the cost of borrowing, right? The cost of the loan that you would eventually need to get, or the cost of the interest payments on your credit cards. Most people don't think that way when they start a business. They assume that the business is going to pay for itself and it's going to be able to pay its own bills. Here's the truth about SBA loans, guys, and how the big banks really are not on your side if you're a small business owner. The SBA rejects almost 98% of all applications. Traditional business loans from banks are also rejected 89% of the time. And that makes sense since most banks are just selling you an SBA loan type of one type or another. A lot of banks just repackage SBA loans and they go through the SBA. Some of them have their own loan products. I know Regions doesn't use the SBA. They back everything at the local branch level. But I mean, a lot of banks that don't use the SBA won't work with startups. They require that you've been in business and have business bank statements for at least 24 months. Now, compare that to alternative lenders. So their decline rate, right, that's the rate that they turn away. The people that they say no to is just 43%. Instead of 90 or almost 100%. You can already see that your odds of being approved by an alternative lender are way higher. They actually say yes more often than they say no. And that's a big deal because 91% of all business lending comes from alternative sources. So I wish I had the figures in front of me, but I just saw it a few weeks ago. I forget how many hundreds of billions of dollars gets lent to small businesses every year. And 91% of that comes from alternative lenders. So what conclusions can we draw? Well, most small businesses are going to need some type of financing. Whether you're brand new or you've been in business for 20 years, it happens, it comes up. And using personal credit is worse than not borrowing at all. Most businesses will need some type of financing to grow at one point or another. However, when you do need to grow, the worst thing you can do is use your personal credit. The only other option is what we're here to talk about today. That's the best option for business. That's your business credit. And that's why we do this. That's why Emory Advisory Group focuses on business credit. It's why we don't even offer personal credit repair. It's really, we focus on entrepreneurs. That's who we like to work with. And our clients had a need that didn't really have a clear solution. And that's why I dedicated a couple of years, really 2 years, to figuring this out. And we broke it down into a science. See, here's what was happening. Our clients were getting stuck. We started off with, like I said, accounting clients. Our clients seemed to be just hitting a wall where they would run out of funding, especially if they were startups, if they were, 2 or 3 years old. They would always hit a wall. They either couldn't afford to grow, they got stuck, they hit a plateau, or else they were starting to fail and they needed a cash infusion to kind of bootstrap the business. And usually what would happen, by the time they asked us for help, by the time they turned to us and asked if we had any ideas, they had already leveraged their personal credit, and it was damaged. Like sometimes they would even, like I saw some people would just deep fry their credit and it couldn't be used anymore. And if they did get approved, by the way, funding was always high interest, and they would get caught on this loop, this cycle. Even if they got approved, it wouldn't help them long term. It would often require them to get another cash advance to pay for the bills. This was a big problem, guys. I saw clients who would get approved for a personal loan, or they would max out their credit cards, and in order to pay the bills, they would have to get a cash advance. Cash advance, that's expensive money. You're talking, 20% interest. I've seen 30% interest. Like, that's not uncommon. And once you have that, and they're taking that money out every day or every week, now you're caught. Now you're stuck. And now you're in big trouble, because now all of your profit that you were counting on for you to pay for your personal expenses, your bills, your family, put gas in the car, food on the table, pay the mortgage, that's all going to pay that cash advance. And they really were unprepared, especially the new business owners we work with. They just totally underestimated the cost of doing business, and it really surprised them. And it always seemed to cost more to get going, and they never made quite as much as they thought or they hoped. And because of the way personal credit is calculated, whenever they would use their personal credit to try and dig themselves out of this hole, it was just totally unsustainable. And guys, here's why you can't count on your FICO. Here's why you can't rely on your personal credit for business use. It wasn't designed for it. It just was not designed to be used for business. It makes no sense. There are 5 categories that make up your FICO score. So 30% of your score is based on utilization. I touched on that earlier. It's basically the percentage of available credit being used or borrowed. So if you have a $10,000 credit limit, you use $5,000, you're 50% utilized, and that will damage your score. Now, 35%, the biggest is payment history. Do you pay your bills on time, right? Do you have a consistent history of paying your bills? 10% is new credit. This is tricky. This is a double-edged sword. Basically, how you shop for credit and within what time frame can affect your FICO in a number of different ways. 15% is length of credit. So how long have you had your accounts open? When was the last transaction? And then another 10% is credit mix. So do you have a combination of credit cards, retail accounts, installment loans, financing accounts, mortgage? You could throw car payments in there, all that stuff. That's what they use. And there's a number of subcategories in there. And by the way, I have acquaintances and friends and people who've either currently work for the consumer credit bureaus, TransUnion, Equifax, Experian, or they used to work there, and none of them have ever really been able to tell me how personal credit really works. There is a mystery there, and I don't fully understand it. It's one of the reasons why I kind of don't like it. I don't like depending on it. I'm going to show you in a moment how business credit is much simpler and how you can depend on it. It's like clockwork every time. Now, here's one of the big things about personal credit that really hurts you when you try to use it for your business. You cannot avoid hard inquiries, and you can't afford them either, because here's why. Whenever you apply for any type of financing with your social security number, there will be a hard inquiry on your credit report. This is a big problem for business owners because you often need to apply several times before you get approved for a business loan. And you know that if you've ever tried to apply for a business loan, you don't usually get approved the first time. You're applying a couple different times with, this bank, you try another source over here, and you end up applying 3 or 4 times. Each time that happens, you get hit with a hard inquiry, and that lowers your score, which in turn, that reduces your odds of being approved because your score has just gone down. In fact, for 90% of lenders, if you have more than 3 hard inquiries on your report in a 6-month period, you are red flagged and considered high risk. They will not consider lending to you. You have to wait. That's a big problem, guys. You cannot operate that way when you're applying for a business loan. If your credit's basically frozen and no one will lend, and the reason why is because if you start applying 2 or 3 or 4 different times, they can see those hard inquiries on your report. And these lenders don't all talk to each other, so they don't know if you've already been approved. So if you're applying for $10,000 here and $10,000 there and $10,000 somewhere else, by the time you get to that 4th person, they see that you've applied 3 other places. You might already have $30,000 in debt, and there's no way you could afford another $10,000, so you're just red flagged. So that's what I mean when I say that using your personal credit's totally unsustainable. You can see that this turns into a big problem. Your FICO goes down the more you apply. Even if you get approved, you're never going to get approved again. It's going to take you months, if not years, to get your credit back where it was. And by the way, I talked about utilization a few minutes ago. Let's say that you did get approved. Let's say you applied for a $50,000 cash advance for your business and you got approved. You used your personal credit to get that. You gave your social security number, and now that line of credit hits your credit report. Because 30% of your credit is based on utilization, that loan is now considered 100% utilized until you start paying it down. So I've seen people who have a 700 FICO score, they get approved, and then their score drops over 100 points overnight, and it will not come back until you pay down the loan. So that's what I mean when I say you're not getting approved again. It's like one and done, and that's it. So their interest rates, again, are high. There's no room to grow. And then this is a key one, guys. You, the borrower, you are not protected. When you give out your social security number, you are not protected. So let's cover basically 4 of the main options here for funding if you're a small business. Let's say that you need $10,000, for whatever. You got to make payroll, you need to buy inventory, whatever it is. Your truck broke down. If you think about your business, So let's say that we got a $10,000 loan here on credit cards. Let's say we use the credit cards, and I'm saying that we're using 11%. I know that's pretty generous. Most of you know that your personal credit cards have interest that's higher than that. I know that you can get 11% interest on credit cards. I've got a personal card that gives me 11% interest, so we'll just be generous. But 11%, that would be the cost of the loan would be about $5,000, $5,080. If we were to go with a home equity loan, the cost of that at 7% is about $3,000. An unsecured personal loan comes in at 9%, so that's a little over $4,000. And then again, a loan in the name of the business comes in again at 7%, just like a home equity loan. That's at 7%, $3,088. Now, this type of loan where it's in your business name, that's unsecured. That means you didn't offer your social security number for that. You got approved based on the merits of your business credit. I realize that it's not better than a home equity loan at 7%. They're the same. And those are real numbers, guys. That's what you can expect when you have good business credit. It wouldn't be much better than that. And some of you might be disappointed. You thought there was cheaper money out there. But keep in mind, if you had to choose between a home equity loan and then a loan in the business name, with one of those options, you are risking your house. So which one would you want? Exactly. In fact, a loan where the revenue potential of the business serves as collateral, that is considered the holy grail of business financing. That's what every business owner wants, and that's what we do for our clients. All right, man, we're going over time here again today. I'm going to try and speed things up. We're going to go fast. So what is business credit? How is it different, and what can you do with it? So question number 2, really quick. Do you know what your Paydex score is? You should see it on your screen right now. And I'm not asking, do you know what the Paydex score is? Just generally. I'm asking, do you know what your business's Paydex score is, your specific business? What's your score right now, today? Do you know what your score is? So I'm going to go ahead and close this really quick. Just 5 more seconds, guys. Please answer if you could. 5, 4, 3, 2, 1. Okay. All right. So it looks like 16% of you know what your business's Paydex score is. Okay. So we'll talk about that. As a business owner, you should know what that is. So let's talk about what is credit for the business. How is it different than personal credit? Well, strictly speaking, business credit is any line of credit or loan that is in the business name. Technically, it needs to be unsecured to be true business credit. That means the owner does not offer a personal guarantee and there's no personal credit check. Business credit is not based on anything except payments. Guys, if you're not paying attention, now's the time. This is a big deal. Business credit, they don't factor anything in except your payments. And I'll show you this in a moment. Do you pay your bills? That's all they care about. So, again, you can get this credit quickly. It doesn't take decades, at least years, right? Your personal credit, you start working on your personal credit when you're like 18. You really don't have a good credit score usually until you're in your mid to late 20s, if you're responsible. But you can get business credit established and built in as little as 90 days. The problem is that most business owners are misinformed on how to go about doing this. Many believe they have business credit when really there is nothing listed on your business credit report. If anything's listed, it's going to be on your personal report because you're not doing it right. Again, guys, I'm going to go fast here. I wanted to throw this back up. We talked about your FICO. Remember these 5 categories? This is your personal credit. And your business credit really comes from this company right here, Dun & Bradstreet, D&B. They are the largest business credit bureau in the world. There's really 2 others in the U.S., Corporate Experian and Corporate Equifax. Experian and Equifax do business credit and personal credit. Excuse me, I need a drink of water. All right, but D&B just does business credit. That's all they do. And they are huge. They are a monster. They have millions upon millions more business credit files on their records than Experian and Equifax combined. In fact, they're bigger in Europe than they are in the United States. They are worldwide. They're huge. They're the beast in the industry. And they are the ones that provide you your Paydex score. So your Paydex score is a dollar-weighted record of your business payments to vendors and creditors that report to the business credit bureaus. The major step that most business owners never consider is that the vast majority of vendors do not report on-time payments. That's just too much of a hassle. If your payments aren't reported, then your score never goes up because the credit bureaus never know about it. And by the way, guys, a lot of the people, I don't want to say a lot of you, a lot of the clients that come to us thinking that they have business credit, it's because they have vendors that they've used like locally in their hometown for years or decades that they've made on-time payments to or even paid their bill early. And they assume that information is there, and it's not, because your local vendor for whatever you do probably doesn't report to D&B, and it's probably not their fault because Dun & Bradstreet won't even accept on-time payment records from vendors that have fewer than 1,000 unique monthly customers that they offer a credit line to. So you have to work with vendors that have more than 1,000 unique payments coming in every month. And if you don't have that, then they don't accept your information. All right, moving on. Here's your Paydex score. This is what it looks like. Your Paydex score correlates with how many days early or late you make your payments. 80 is on time. You're right here, 80. That's your on-time payments, guys. So if you pay your bill on time, congratulations, you have a mediocre score. If you really want your score to go up, you got to pay early. And I have a chart in my office that breaks it down, not like this, it breaks it down by every single day. So when I pull up your Paydex score, I know exactly what day of the month you pay your bills on. If you pay your bill a day late, I'll know. And that's what lenders look at. So how do we do it? How do you build your business credit? Well, you have to embrace the process, guys. It doesn't happen on its own. Getting your business credit where you want it to be, it requires careful attention. I know that in a group this size, there are brand new business owners as well as seasoned ones that have been in business for 20 or more years. And I also know that being in business for a long time does not mean you aren't struggling, and it doesn't mean you've got this all figured out. If you haven't taken very specific action to establish everything that we've been talking about, then your business credit is languishing, regardless of how long you've been in business. And this is why you can't afford to ignore it, guys. If you ignore it, it's not gonna help you. It's not gonna build itself, and you'll never get the benefits. It's actually made for business. Imagine using a power drill for the first time when you've only ever used a screwdriver your entire life. Would that change your life? You know, if you're a contractor, right? It probably would. The benefits of using business credit over your personal credit are huge. You instantly get better terms and higher limits. In fact, most unsecured business credit lines receive limits that are 5 to 10 times higher. And no more damaging hard inquiries on your credit. Your business credit is public information and it's not subject to the Fair Credit Reporting Act. That means there's no such thing as a hard inquiry. You can safely shop for better rates and terms without your score going down. And utilization is not factored. So as long as you pay your bills on time or early, your score will keep going up. Whenever you provide your social security number guys, hold on, time out. Liability protection. If you're not paying attention, here's where you need to wake up. I need everyone's attention right now. Liability protection is a big deal in business. You don't want to put yourself on the line for every single business line of credit that's out there, and you need to separate yourself from the business. If you really want peace of mind, this is what we're talking about. Whenever you provide your social for credit or funding, you are accepting the role of guarantor. This effectively removes any liability protection or separation you have from the business, even if you have an LLC. Even if the loan is in the business name, you are basically the cosigner. This is another reason why no CEO gives out their social when a large corporation applies for credit. The business stands on its own. Guys, do you really think that the CEO of Walmart gives out their social when they need a line of credit? No, I don't think so. And also, by the way, this is totally separate, but did you know that over 3/4, over 75% of everything on the shelves in Walmart is purchased by Walmart on credit? So they don't pay up front for it. It sits on the shelf. They don't go into any debt. And then when you buy it, then they pay the supplier. Now that is a way to cash flow a business. So here's the benefits, guys. Here's what you've probably been missing. You get lower rates. You spend way less on fees. Consistently lower rates on credit cards, lending fees, insurance, even utilities. I don't have a ton of time to talk about this, but did you know that when you, let's say you move into a new location, you got to have the electricity turned on, the water or gas or whatever. They do a credit check. If you give your social, they check your personal credit. If you give your tax ID and you have business credit established, they will check your business credit. And with good business credit, you can have a lower security deposit on that, lower down payment. You might even get cheaper rates for your utilities. I've seen it. You get higher limits. Higher limits, right? Credit limits are way higher. We already talked about this, but 5 to 10 times higher than consumer credit. I mean, if you have a good personal credit and you apply online for, a Visa or credit card or whatever, you might get a $5,000 initial limit, and you can always ask for an increase, but 5,000 is pretty typical. If let's say your FICO 700. If you have an equivalent Paydex score, then instead of a $5,000 limit, it could be 15, 20, 25, even like $40,000 or $50,000 on that same credit card, because it's a business card. It's using your business credit, and they realize that businesses need more money than consumers. Most businesses operate on credit. They expect it. It's totally normal. You also get asset protection. You get to separate yourself from your business, and you can keep your business from affecting your personal credit. And we don't really talk about this much, guys, but just as an aside, when you get good business credit and you've been using your personal credit for so long to operate the business, you can actually transfer balances and transfer debt over to the business. And then just kind of as a side benefit of having good business credit, it's going to help fix your bad business credit. You get to repair your personal credit. And then finally, the big one that I like the most is you get to keep your money. You instantly improve your cash flow. You get to leave more money in the bank. You pay your bills when it makes sense for you, and you'll never bounce another business check again. And by the way, when you're applying for funding from a bank, if you need a bank loan, the first thing that banks look at when you apply for a business loan is the average daily balance in your bank account. And if your bank account is always low, guys, then you're not getting approved. We already talked about this. I don't have time to go over it again, but just to reinforce what we just talked about. Business credit's not about going into debt. It's about growing your business, improving your cash flow, having money when you need it to take the next step. You never get stuck. Okay, we're really over here, so really quick. In fact, I'm not even going to ask this question. Well, why not? I'll go ahead and put it up. Hold on. So have you ever had to skip a paycheck to cover business expenses? Just be honest. I already know most of you have. But have you ever had to do that? As an entrepreneur, I know you make sacrifices. I know I have. I did at the beginning when I was starting my business. I'm going to go ahead and leave this open for just 3 more seconds, and then we'll close it. 3, 2, 1. All right. Okay, so that basically speaks for itself right there. So out of everyone who's watching the webinar today, if everybody answered, that's just about everyone. Guys, this is what business credit helps with. It helps you manage your cash flow. You can pay the things that are important to you. You can take care of your family and make sure you always have money to pay your bills, and the business is going to be just fine. Now, I promised that at the end of the webinar, you'd have a chance to ask questions. So here's what we're doing. We're way over time. If you have questions, our credit advisor team that coaches our clients, we will set aside 30 minutes to answer your questions. So if you've written down questions as you've been watching, or if you want to know how business credit can affect you and help you, because I know that every business is unique. And if you want to know how to apply this to your business, here's what you do. A link is going to appear on your screen right now. And you go ahead, click that link, and you can book an appointment with our advisor team. They'll set aside 30 minutes. Not only will they answer all of your questions and talk to you about this, about your business, but we'll go over 4 really important things for you that you need to know. First, we'll talk about the number 1 reason why credit applications get declined and how you can easily make sure you qualify in as little as 30 seconds. We're going to go over the first 3 requirements to set up before you start applying for credit. And there's an order in which you need to do these things, guys. And like I said, I teach another course. It's a 6-hour online training course that covers all of this stuff. So again, we're just getting into the basics here, but these are critical. We're also going to show you how to set them all up in the right way to make sure you get approved. We're going to talk about the 2 requirements for your phone number. Did you know that your phone number alone can get you declined for a loan if you don't have it set up right? And then finally, guys, we're going to talk about how to guarantee $50,000 in unsecured credit for your business in as little as 90 days. So that's it for me, guys. I really, really appreciate all of your attention today. I apologize for going over again. I had really good intentions to keep it brief, but there's just way too much to cover. I hope that we get a chance to talk with you. Please take advantage of this opportunity to book this appointment with our advisor team. We are doing it this week and this week only. Our advisors are very busy. Normally they're busy talking with our customers and our clients. But for this week only, while we're doing the webinar series, I want you to jump in and take advantage of it. So hopefully we'll speak with you. And guys, again, thank you so much. I want to thank you personally from all of the advisors and everybody here at Emory Advisory Group. We thank you as well. And I wish you guys the very best of luck with your business. Thanks a lot.